What happens when a car company stops acting like a car company and starts behaving like one of the most efficient compute platforms in the world? On April 15, Tesla stock jumped more than 7% in a single session, breaking above its 5, 10, and 20-day moving averages and wiping out weeks of bearish momentum. And this move had nothing to do with vehicle deliveries. Instead, the market is starting to price in 3 letters: AI5. This is Tesla's next-generation chip, what Elon Musk has called the existential core of the company's future. While retail investors have been quietly accumulating shares, several institutional analysts have begun issuing bullish price targets that imply a potential doubling from current levels. Today, we're breaking down why the AI5 chip is driving a major shift in capital from Nvidia and into Tesla's vertically integrated ecosystem. My name is Phoebe, and you're watching Trading Key. Efficiency over raw power. Elon Musk recently confirmed that Tesla's AI5 chip has reached tape-out, the final design stage before production. But why does that matter? Because the real story here is unit economics. Right now, the AI arms race is centered around Nvidia's Hopper and Blackwell chips, which rely heavily on expensive high-bandwidth memory, or HBM. Tesla is taking a different approach. Instead of relying on traditional HBM stacking, AI5 is designed around a more customized architecture of placing multiple DRAM modules directly alongside the compute core. The goal is simple: reduce latency, improve efficiency, and lower power consumption. And that matters a lot. Whether it's autonomous vehicles or humanoid robots, power efficiency isn't just a feature, it's a constraint. You can't deploy real-world AI systems that overheat or require constant recharging. On the performance side, the jump is significant. AI5 is expected to move to advanced process nodes, delivering a major step up in inference capability compared to prior generations. Now, Tesla is building a highly specialized AI processor, optimized for real-world deployment, not just data centers. Tesla as a distributed network. But the real opportunity isn't just the chip, it's the business model. Tesla is gradually shifting from being an EV manufacturer to something closer to a distributed compute platform. Think about it. By the late 2020s, millions of Tesla vehicles could be running advanced onboard compute, and most of those vehicles sit idle the majority of the day. The long-term vision? Turn that idle compute into a network. In theory, Tesla could leverage its installed base to support distributed inference workloads, creating a new layer of monetization beyond the initial vehicle sale. That means each car could generate value twice, once as a product, and again as part of a broader compute ecosystem. This is why some institutional analysts are starting to rethink Tesla's valuation framework. They're not just modeling car sales anymore. They're modeling software margins, autonomy, and potential compute-driven revenue streams. Manufacturing and execution risk. Of course, custom chips require custom manufacturing. AI5 reaching tape-out is just the first step. Scaling production is the real challenge. Tesla has ambitions to push deeper into manufacturing efficiency, potentially lowering costs through vertical integration and energy optimization. But there's a key constraint here. Advanced chip production still depends heavily on foundries like TSMC and Samsung. And capacity at cutting-edge nodes is extremely tight, with major players like Apple and Nvidia already competing for supply. So while Tesla can control design, it doesn't fully control fabrication. That makes execution the critical variable. If Tesla can secure enough capacity and scale production efficiently, the upside is meaningful. If not, that becomes the bottleneck. A shift in the narrative. As of April 2026, we're starting to see a shift in investor behavior. Some data suggests retail capital has begun rotating out of Nvidia and into Tesla, while institutional views remain widely split. And that divergence comes down to one thing: earnings expectations. Bullish cases on Tesla are increasingly tied to long-term growth in software, autonomy, and AI, not just vehicle sales. At the same time, Tesla continues to hold strong relative positioning within the EV market, even as broader demand fluctuates. The AI5 chip represents a potential turning point. If Tesla executes, it could shift from being a cyclical hardware company to a more structural AI-driven platform. But that transition depends on two things: technical delivery and manufacturing scale. So, can Tesla actually scale this vision, or will supply chain constraints limit its impact? Let me know what you think in the comments down below. Thanks for joining me today. If you found this video helpful, remember to subscribe to Trading Key, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.